I'd like to begin with news that Bloomberg broke just this afternoon that the OCC, together with the Fed and FDIC, are looking at introducing a plan to require banks to tap the Fed's discount window at least once a year. Why make them tap a liquidity backstop that they may not need?
It's a great question, and I think it helps to back up a little bit and say, why are we doing this? And it's because the speed of bank runs has gotten faster. Last year, in 2008, you had Wachovia and Washington Mutual. They failed. They endured $10 to $20 billion outflows over 2 weeks. Last year, almost exactly a year ago, you had Silicon Valley Bank endured $40 billion in a single day. So we clearly need to build better brakes for a faster financial world, and that's what I talked about earlier today.
We also understand regulators would have to craft plans to borrow in a pinch, if you will. Isn't that the idea here? Why force someone to the discount window when there might be something more readily available in the case of an emergency?
So I want to be very clear. We're not forcing anyone to do anything at this stage, right? So this proposal that I previewed earlier today was to say merely having liquid assets does not guarantee that those assets can be turned into cash as needed when there's a run. And the best place to get that cash in a pinch is the Federal Reserve at the discount window. And if banks want to be able to convert their assets into cash, if there's a really quick run like what we saw last year, they need to be ready at the discount window. So part of today's preview was to talk about that.
Well, so how great do you think the risk is that an episode like what we saw back in March of 2023 could happen again? Do you think imminently banks may face those kind of liquidity challenges, the sudden withdrawal of funds?
No, I don't think it's imminent. And that's why we're taking our time to get this right. What's really critical is that uninsured deposits, there's a lot of uninsured, there's over $7 trillion of uninsured deposits in the system. What we saw last year, there was some uncertainty around that. Now, we've solved a lot of that through supervision on an individual bank-by-bank basis. What I previewed today was to say, can we basically address this now through regulation in an efficient, targeted manner so it's consistent and can provide a lot of confidence to everybody?
Well, and on the idea of confidence, or at least feeling confident doing something like tapping a discount window without fear of stigma, is that also what this is about? Is that what you're really trying to address?
Absolutely, because the discount window is there to be used. There has been stigma with it, however, and part of what led to the issues last year was that stigma was part of the problem. What we need is to incentivize appropriate use of the discount window without incentivizing moral hazard and bailouts. And then what I talked about earlier today was trying to craft a requirement, really focus on short-term outflows, 5 days, that would really address that particular issue.
I'm just curious about this idea of reducing stigma. I mean, this is like human nature that we're talking about. Is your hope that incentives will not be required once this becomes second nature?
So the issue with stigma is that borrowing from the discount window was seen or is seen as a sign of weakness and can accelerate the run. And so by making a short-term requirement where it gives credit for discount window access for liquidity purposes, we're basically saying we as regulators expect banks to borrow from the discount window for very short periods of time where that collateral has been pre-positioned at the discount window, so there's no risk to the taxpayer. We are incentivizing that for those short periods of time without begging the moral hazard that comes with longer periods of discount window borrowing.
What about those borrowing costs, though? Is there any consideration of potentially lowering discount window rates?
So that's going to be a decision for the Fed as they set up the program. What we're trying to do here is to put the idea together, and we will put a proposal out once the agencies come together on this, and it'll be available for comment. And part of the comment process is to work through the calibration and the framework and those issues such as the funding costs.
How does this whole idea interact with the proposal for banks to hold capital to help them weather a crisis?
So we obviously want to think about everything holistically, but capital is different than liquidity. And with liquidity, the real focus is, can banks meet those outflows as outflows occur on a day-by-day basis, hour by hour? Do they have the cash to meet that, to continue operations? There is going to be an interactive effect with capital. We're going to look at that really closely. But for this focus, it's really, can banks survive? And we saw that they're going to need the capacity. Sometimes they have the assets, but they can't turn it into cash fast enough. And this would help with that.
Well, on those capital requirements, obviously, we've saw a comment period on that as well. There has been a lot of pushback, not just from banks and even lawmakers on Capitol Hill, but internally within the Fed. We've heard a bit of that this week. I know that you are a different regulator, but I'm wondering how the OCC thinks about it when someone like Fed Governor Michelle Bowman said the capital proposal needs substantial changes. Christopher Waller says it needs a major overhaul, may need to be scrapped altogether. From your point of view, what changes are we actually likely to see?
So the comment period just closed. We've got lots and lots of comments. We're going to work through those very, very carefully, very deliberatively. I have signaled in the past, and I'm going to say again, we are open-minded to evidence of improvements that can be made. And we're going to look at the analysis. We're going to do the work. Obviously, there's been a lot of comments on this thus far. A lot of that's coming in. And we'll take all of that into account because we want to make this rule the best it can be, where it strengthens the banking system and it strengthens the economy.
Well, what the banks will tell you is actually it's going to reduce lending to small businesses because they're going to need to keep more capital on the side. Therefore, they're not going to be putting it other places. At least that's the messaging from some of the big banks, which obviously are going to face the most stringent requirements. Their capital requirements going to go up the most. I wonder for mid-sized players, though, how you're thinking about how these kind of rules will make them competitive versus bigger banks who may be able to take it. Could actually, as a result of more strict capital requirements in the Basel III endgame, there need to be more consolidation among some of these other players?
So I want to be really clear. The proposed Basel III endgame applies to banks with $100 billion of assets and above. So banks that are not in that category aren't going to be impacted by Basel III.
Okay, but do you think there is a world in which, especially knowing as a result of the banking crises back in March that we talked about, JP Morgan got even bigger. They just had a blowout year as a result, that some of these other smaller players may need to consolidate regardless of those capital requirements, but just to compete with big guys that are just getting bigger and are the most resilient?
Yeah, so we've got a dynamic, it's a strength of the U.S. banking system. It's dynamic and it's diverse. And that's really, really critical because we have a very dynamic and diverse U.S. economy. And so I think that that's natural. There's a naturalness to that. Now, we need to make sure that every merger is pro-competitive, pro-community, pro-financial stability. These are parts of the statutory framework. Those are the criteria we use to evaluate every single merger. But you know, there are a lot of forces that lead to different mergers. It's not just regulation. And all of that comes to bear, you know, for us as the OCC, as a bank regulator, we need to make sure that each merger fulfills all of those statutory requirements.